How long can the growth to value shift and the value run historically go?
It can go a long time, Brian. And, I was on your show last August and I was talking about energy, and it was almost like a curse word last August to say, look, it might be a good time to move out of some of your tech positions and move into energy. And, what we've seen here is we've seen a huge move up. You're just talking about oil. The XLE is up big this year at $68 a barrel as we're recording this right now, or it's live right now. And, the thought on Wall Street right now is maybe this whole trend is transitory. Big tech's going to be the place to be like it was the last decade. And we're having this move up in inflation right now, as the Fed says transitory. It's not something that's going to last a long time. But if you look at a value cycle, historically, it could last as long as 33 months. We're only 6 months into this. It was really only in November when we first got that vaccine news that all of a sudden we start to see that big rotation out of big tech, or I call long duration assets, right? Anything where you're waiting for profits that can be priced in for, in some cases, like 100 years, if you're Tesla, and you're really seeing money move out of that part of the market into more cyclical positions that benefit from really profits reaccelerating. That's what's happening right now.
Yeah, and we've shown that the gap between the oil price and oil stocks is this huge gap. Usually when oil's at 68 or 70, oil stocks are somewhere up there as well. They're not, maybe because, to your point, it's a dirty word, ESG. People have dumped it. But it's not just that. The valuation gap between, say, the Russell growth sector and the Russell value sector is still historically high. That's going to come down, you think, at some point?
Yeah, it has to. It has to. Because, look, at the end of the day, the market's a slave to earnings. And at the end of the day, money's going to find where profits are accelerating. And last year, it was the perfect storm, right? We were all locked in at home. If you're Peloton, you just thank the market gods that, look, you're going to come out with a bike this year. We're going to go public. And everyone's going to have to be locked in at home. So they're going to buy your bike. Like, perfect storm, right? But now we have the exact opposite. People are going outside again. People are going to go on trips again. People are going on vacation. So all that money is going to flow into basically being outside, not inside. And who benefits the most from that? All the stocks that got hammered last year. And all the profits that are going to accelerate are going to be in those areas. And the other thing is, you have to think about last year.
So what do we, Ryan, what do we do? Do we buy oil and gas stocks here? What are we buying? What are we doing?
Yes, the trend is not over. You haven't missed it. Yeah, I would add to energy here. I'd add to financials here. I'd add to materials. Anywhere that's cyclical, Brian, you've got to have in your portfolio. And also the dollar's weakening. Money's going around the world again. You just mentioned Europe. Europe's running hot. You said it should have been red this morning. I'd have money globally as well right now, because next year GDP growth is going to be even faster in Europe than it is in the U.S. So you've got to be global here. You've got to be in value positions. You got to have cyclical positions. You got to move out of having everything in tech, which I see most portfolios are still the portfolio of the last 10 years, not the next 10 years.
Shepard Smith here. Thanks for watching CNBC on YouTube.